Question 1. Legal and regulatory framework. Which of the following statements best describes the regulatory requirements for a reinsurer to operate in Idaho under the state's Department of Insurance guidelines? A. The reinsurer must be licensed only in its home state, and no additional registration is required in Idaho. B. The reinsurer must be licensed in Idaho and must comply with both state and NAIC solvency requirements. C. The reinsurer can operate without any licensing if it has a treaty agreement with an Idaho-based insurer. D. Reinsurers are required to file only annual financial statements with the Idaho Department of Insurance, regardless of their licensing status. Answer. B. Explanation. To operate in Idaho, a reinsurer must be licensed by the Idaho Department of Insurance and comply with both state-specific and NAIC solvency regulations. According to Idaho state law, a reinsurer must demonstrate financial stability and meet capital reserve requirements to ensure they can cover their assumed risks. Option is incorrect because Idaho requires direct licensing for reinsurers operating in the state, even if they are licensed elsewhere. Option C is incorrect because treaty agreements alone do not exempt a reinsurer from licensing requirements. Option D is incorrect because filing annual financial statements is a part of compliance, but licensing and solvency standards are mandatory. Relevant rule, Idaho Code Title 41515, NAIC accreditation standards. Question 2. Scenario-based claims handling in reinsurance. Michael, a claims manager at an Idaho-based primary insurer, receives a catastrophic loss claim related to wildfire damage that exceeds the insurer's retention limit. The insurer has proportional quota share treaty in place with reinsurer. The primary insurer submits claim to the reinsurer. However, the reinsurer disputes the payment, citing insufficient documentation. Michael, that the documentation provided is adequate. What is the best course of action for Michael to resolve this dispute under Idaho reinsurance practices? A. Michael should initiate legal proceedings against the reinsurer immediately to enforce payment. B. Michael should notify the Idaho Department of Insurance to impose penalties on the reinsurer. C. Michael should engage in arbitration with the reinsurer as outlined in the treaty agreement. D. Michael should cancel the treaty agreement and seek reinsurance from another reinsurer. Answer. C. Explanation. Arbitration is the preferred and often required method to resolve disputes in reinsurance contracts. Most reinsurance treaties include arbitration clauses to avoid lengthy and costly court cases. Engaging in arbitration ensures that both parties present their cases to a neutral arbitrator who can provide a fair resolution. Option A is incorrect because initiating legal proceedings without first exhausting the arbitration process is not recommended and would likely breach the treaty terms. Option B is incorrect because regulatory bodies intervene primarily in cases of significant non-compliance, not contractual disputes. Option D is incorrect because cancelling a treaty agreement does not address the current claim dispute and may cause further financial complications for the primary insurer. Relevant rule, Idaho Department of Insurance Guidelines, NAIC Reinsurance Arbitration Best Practices. Question 3. Reinsurance, pricing and negotiation. Which of the following factors is least likely to directly impact the pricing of a reinsurance contract? A. Historical loss data from the ceding company. B. Market competition among reinsurers. C. The reinsurer's retrocession costs. D. The specific legal framework of the ceding company's state. Answer. D. Explanation. While legal frameworks influence overall compliance and solvency requirements, they do not directly impact the pricing of reinsurance contracts. Pricing is primarily driven by the ceding company's risk profile, historical losses, market dynamics, and the costs incurred by the reinsurer, including retrocession expenses. Option is key factor in pricing, as reinsurers assess the ceding company's past loss experience to gauge future risk exposure. Option B is also a critical factor, as competitive market conditions influence premium rates. Option C is essential, as the reinsurer must account for their retrocession costs when setting prices. Option D is the least relevant in pricing decisions, as legal frameworks pertain more to regulatory compliance rather than direct pricing factors. A relevant rule, NAIC Reinsurance Pricing Guidelines, Idaho Reinsurance Regulatory Framework. Question 4. Types of reinsurance agreements. Which of the following best describes the key characteristic of a non-proportional reinsurance agreement, such as excessive loss reinsurance? A. The reinsurer receives a percentage of the premiums proportional to the amount of risk transferred. B. The reinsurer assumes all losses above a certain threshold and the ceding company retains responsibility for losses below that threshold. C. The reinsurer only participates in losses that exceed the ceding company's retention limit, but within defined proportion of the total risk. D. The reinsurer and the ceding company share both premiums losses equally regardless of the amount of risk transferred. Answer B. Explanation. Non-proportional reinsurance, such as excessive loss, involves the reinsurer assuming losses that exceed a specific retention threshold set by the ceding company. The reinsurer does not participate in losses below that level, and the ceding company retains responsibility for losses within its retention. This structure is designed to protect the ceding company from severe losses. Option A describes proportional reinsurance, not non-proportional. Option C describes a type of proportional reinsurance or quota share where the reinsurer shares the loss based on a fixed proportion. Option D also describes a proportional reinsurance arrangement. Relevant rule, NAIC non-proportional reinsurance guidelines. Question 5. Risk assessment and underwriting in reinsurance. Which of the following is least likely to be considered in the underwriting process of a reinsurer when evaluating a treaty agreement? A. The loss history of the ceding company in its line of business. B. The financial stability of the reinsurer's retrocessionaires. C. The marketing practices and promotional activities of the ceding company. D. The geographical concentration of the ceding company's risks. Answer C. Explanation. Marketing practices and promotional activities of the ceding company do not significantly impact the underwriting evaluation of a reinsurance treaty. Underwriting decisions are primarily based on the ceding company's risk exposure, loss history, financial stability, and the geographical concentration of its risks. These factors directly affect the likelihood and severity of potential claims. Option is critical factor as loss history helps assess the risk exposure and potential for future claims. Option B is relevant because the reinsurer must evaluate the stability of any retrocessionaire as it could impact their ability to pay claims. Option D is important because geographical concentration increases risk exposure, especially in catastrophe-prone areas. Relevant rule, NAIC reinsurance underwriting standards. Question 6. Reinsurance, pricing and negotiation. Which of the following would most likely increase the cost of reinsurance premiums in a treaty agreement? A decrease in the retention limit for the ceding company. B. A longer duration of the reinsurance agreement. C. A more diversified portfolio of risks held by the ceding company. D. An increase in the historical loss experience of the ceding company. Answer D. Explanation. An increase in the historical loss experience of the ceding company is likely to result in higher reinsurance premiums. Reinsurers price contracts based on the expected risk, and if a company has a poor loss history, the reinsurer will adjust the premium to reflect the higher likelihood of future claims. Option A would decrease the reinsurer's exposure and potentially reduce premiums, not increase them. Option B does not directly correlate to an increase in premium unless it involves greater risk exposure. Option C is likely to lower the risk concentration and potentially reduce premiums depending on the risk portfolio. Relevant rule, NAIC reinsurance pricing methodology. Question 7. Reinsurance audits and reviews. During a reinsurance audit, which of the following would most likely be flagged as a concern regarding the ceding company's reinsurance recoverables? A. The ceding company's reinsurance recoverables exceed its statutory surplus. B. The reinsurance recoverables are fully secured through trust agreement with the reinsurer. C. The reinsurance recoverables are being reported consistently in all financial statements. D. The reinsurance recoverables are subject to claims only after a period of 24 months from the loss date. Answer A. Explanation. If the ceding company's reinsurance recoverables exceed its statutory surplus, this could be major concern. Statutory surplus is a critical financial measure, and excessive recoverables could signal that the company is overly reliant on reinsurance or could have difficulty covering its liabilities without the reinsurer's payment. Option B is not concern if the recoverables are secured, which actually strengthens the financial position. Option C is not concern as long as the recoverables are reported consistently. Option D is valid contractual stipulation and would not raise concern unless it violates the treaty terms. Relevant rule, NAIC financial reporting requirements. Question 8. Claims handling in reinsurance. Which of the following is not typically a responsibility of the reinsurer in the claims settlement process? A. Paying claims within the terms of the reinsurance treaty. B. Participating in the determination of claim amounts. C. Settling claims directly with the policyholders of the ceding company. D. Monitoring claims to ensure they align with the conditions of the reinsurance treaty. Answer: C. Explanation. The reinsurer does not typically settle claims directly with the policyholders of the ceding company. Claims are generally handled by the ceding company, which then submits the recoverable portion to the reinsurer based on the terms of the reinsurance treaty. Option A is correct, as the reinsurer must pay claims according to the treaty terms. Option B is correct, as reinsurers are usually involved in verifying and agreeing on the amounts of claims. Option D is correct, as reinsurers monitor claims to ensure that they are within the treaty terms and conditions. Relevant rule: NAIC claims handling and settlement guidelines. Question 9. Advanced reinsurance concepts. Which of the following best describes the primary goal of using catastrophe bonds, cat bonds, as an alternative risk transfer mechanism in reinsurance? A. To allow reinsurers to transfer a portion of their risk to investors in the capital markets. B. To allow ceding companies to purchase more reinsurance coverage without increasing their premiums. C. To allow reinsurers to reduce their administrative expenses by outsourcing risk assessment to third-party entities. D. To provide liquidity to the ceding company in the event of an adverse loss development. Answer A. Explanation. Catastrophe bonds, cat bonds, are designed to allow reinsurers to transfer a portion of their risk to investors in the capital markets. This helps to diversify risk and provide additional capital for catastrophic events without relying solely on traditional reinsurance markets. Option B is incorrect, because cat bonds do not reduce premiums, they provide an alternative source of capital. Option C is incorrect, because cat bonds do not primarily address administrative expenses. Option D is incorrect, because cat bonds are not primarily used for providing liquidity but for transferring risk. Relevant rule: NAIC catastrophe bond guidelines. Question 10. Reinsurance risk mitigation techniques. Which of the following is the primary benefit of using retrocession as a risk mitigation technique in reinsurance? A. It increases the reinsurer's capital reserves, allowing them to underwrite more policies. B. It allows reinsurers to pass on a portion of their risk to another reinsurer, thereby reducing their exposure. C. It reduces the cost of reinsurance premiums by diversifying the ceding company's risks. D. It enables reinsurers to handle claims more effectively by outsourcing claims handling to retrocessionaires. Answer B. Explanation. Retrocession involves reinsurers passing on a portion of their risk to other reinsurers, thus spreading their exposure. This allows the reinsurer to reduce the amount of risk they retain on their own balance sheet, providing greater financial stability. Option is incorrect, because retrocession does not directly increase capital reserves. It transfers risk. Option C is incorrect, because retrocession does not necessarily reduce the cost of premiums. Option D is incorrect, because retrocession does not involve outsourcing claims handling. Relevant rule: NAIC retrocession guidelines. Question 11. Reinsurance pricing and negotiation. Which of the following factors would most likely lead to a reduction in the reinsurance premiums for a ceding company in a proportional reinsurance arrangement? A. An increase in the historical loss experience of the ceding company. B. A higher retention limit agreed upon by the ceding company. C. A decrease in the ceding company's risk exposure due to diversification. D. An increase in the number of claims under the treaty during the policy period. Answer C. Explanation. A decrease in the ceding company's risk exposure due to diversification is likely to reduce the reinsurance premiums. Diversification lowers the overall risk of the portfolio, which makes the ceding company more attractive partner for the reinsurer, leading to potentially lower premiums. Option would likely increase premiums, as higher loss experience indicates more risk to the reinsurer. Option B would typically increase the reinsurer's risk and may increase premiums. Option D would increase premiums, as higher claims increase the risk for the reinsurer. Relevant rule: NAIC pricing standards for reinsurance contracts. Question 12. Claims handling in reinsurance. When a claim is made under a reinsurance contract, which of the following is not typically the responsibility of the ceding company? A. Providing all necessary documentation to the reinsurer for the claim. B. Settling the claim with the policyholder according to the primary insurance policy terms. C. Determining the amount of loss that is recoverable from the reinsurer. D. Notifying the reinsurer promptly upon occurrence of the loss. Answer. C. Explanation. The determination of the amount of loss that is recoverable from the reinsurer is typically the responsibility of the reinsurer, as they will assess whether the claim is valid under the terms of the reinsurance agreement. The ceding company's role is to provide information and settle the claim with the policyholder. Option is responsibility of the ceding company to provide supporting documentation for claims. Option B is the ceding company's responsibility as they directly settle with policyholders. Option D is requirement in most reinsurance contracts for the ceding company to notify the reinsurer promptly. Relevant rule: NAIC Claims Handling Guidelines for Reinsurance. Question 13. Legal and regulatory framework. Which of the following is most likely to result in a reinsurer losing its license in the state of Idaho? A. The reinsurer fails to comply with federal solvency standards. B. The reinsurer does not meet the capital requirements outlined by the Idaho Department of Insurance. C. The reinsurer's loss ratio exceeds 120% for single policy year. D. The reinsurer fails to update its reinsurance contract after 12 months. Answer. B. Explanation. In Idaho, reinsurers must meet specific capital and solvency requirements set by the Idaho Department of Insurance. Failure to meet these requirements could result in the suspension or loss of a reinsurer's license. Option is a federal issue but does not directly impact the state-level licensing in Idaho. Option C refers to the loss ratio, which is not directly tied to licensing requirements in Idaho. Option D refers to contract updates which, while important, do not directly lead to license revocation. Relevant rule: Idaho Department of Insurance Licensing Regulations. Question 14. Risk assessment and underwriting in reinsurance. Which of the following factors would most likely be considered when determining the underwriting guidelines for a reinsurer evaluating a catastrophe reinsurance agreement? A. The general market conditions for the ceding company's primary insurance products. B. The ceding company's solvency ratio and capital reserves. C. The historical frequency and severity of catastrophic events in the ceding company's market. D. The geographical spread of the ceding company's risk portfolio. Answer. C. Explanation. Catastrophe reinsurance is primarily concerned with the frequency and severity of catastrophic events. This includes an evaluation of the potential for large-scale losses due to natural disasters or other catastrophic events. This is a major factor in underwriting catastrophe reinsurance. Option is more relevant for general reinsurance, not specifically catastrophe risk. Option B is important but would be more relevant to general underwriting practices, not catastrophe-specific underwriting. Option D is important but does not address the core concern of catastrophic events. Relevant rule: NAIC Catastrophe Reinsurance Guidelines. Question 15. Types of reinsurance agreements. Which of the following statements best describes surplus share reinsurance? A. The reinsurer assumes a fixed proportion of the ceding company's risks and losses. B. The reinsurer only assumes losses that exceed the ceding company's retention, but only within specific proportion of the total risk. C. The reinsurer agrees to cover percentage of each loss in proportion to the total amount of the ceding company's policies. D. The reinsurer agrees to cover portion of losses above the ceding company's retention, but without proportionality involved. Answer. B. Explanation. Surplus share reinsurance is a non-proportional agreement where the reinsurer assumes losses that exceed the ceding company's retention, but only within defined proportion of the total amount of risk. The reinsurer only becomes liable once losses surpass the ceding company's retention limit. Option describes quota share, form of proportional reinsurance. Option C describes proportional reinsurance, but not specifically surplus share. Option D describes excessive loss reinsurance, not surplus share. Relevant rule: NAIC Surplus Share Reinsurance Guidelines. Question 16. Ethics and professional standards. Which of the following would most likely be considered an unethical practice in reinsurance? A. A reinsurer providing a bonus to the ceding company for exceeding loss limits. B. A reinsurer offering lower premiums for policies with higher retention limits. C. A reinsurer intentionally delaying claims payments in an effort to reduce exposure. D. A reinsurer accepting risk that falls outside of the parameters outlined in the reinsurance agreement. Answer. C. Explanation. Intentionally delaying claims payments to reduce exposure is unethical and violates the trust and obligations outlined in reinsurance contracts. Reinsurers are obligated to pay claims in a timely manner according to the terms of the contract. Option is not unethical as long as it's disclosed and within contractual terms. Option B is standard pricing strategy that may reflect risk-based pricing. Option D is an issue of breach of contract but not necessarily unethical if not intentional. Relevant rule: NAIC Code of Ethics for Reinsurance Professionals. Question 17. Legal and regulatory framework. Under Idaho law, which of the following would be most likely required for a reinsurer to demonstrate its financial stability before entering a contract with a ceding company? A. A review of the reinsurer's prior claims history. B. Review of the reinsurer's retrocessionaire arrangements. C. An independent audit of the reinsurer's financial statements. D. An analysis of the reinsurer's solvency ratio compared to industry benchmarks. Answer: C. Explanation. Idaho law requires reinsurers to provide an independent audit of their financial statements as a demonstration of their financial stability before entering into reinsurance agreements. This audit verifies that the reinsurer has sufficient capital to fulfill its obligations. Option is important but not typically required for financial stability assessment. Option B is relevant to risk management but does not directly address financial stability. Option D is important but would typically follow after the financial audit is completed. Relevant rule: Idaho Department of Insurance Solvency Regulations. Question 18. Reinsurance market and trends. Which of the following is most likely to influence the pricing of reinsurance premiums in response to emerging risks, such as cyber threats? A. Increased exposure to emerging risks may lead to higher premiums for both primary insurers and reinsurers. B. Reinsurers will reduce premiums for emerging risks due to advancements in technology and data modeling. C. Increased competition among reinsurers for emerging risks will lead to a reduction in premiums. D. The ceding company's retention levels have no impact on the reinsurance premium for emerging risks. Answer: explanation. Increased exposure to emerging risks, such as cyber threats, typically leads to higher reinsurance premiums. These risks are harder to quantify and reinsurers may charge more to account for the uncertainty and potential for large claims. Option B is unlikely as emerging risks often lead to higher premiums due to their unpredictability. Option C does not reflect the general trend as emerging risks tend to increase premiums rather than decrease them. Option D is incorrect because retention levels can influence premium pricing, especially for emerging risks. Relevant rule: NAIC Emerging Risks Guidelines. Question 19. Risk assessment and underwriting in reinsurance. Which of the following would most likely be included in a reinsurer's assessment when evaluating the risk of new treaty agreement? A. The marketing strategies of the ceding company. B. The financial strength of the ceding company. C. The reinsurance commission rates agreed upon. D. The type of reinsurance treaty the ceding company has with its policyholders. Answer: B. Explanation. The financial strength of the ceding company is a critical factor for the reinsurer when evaluating risk. A strong financial position of the ceding company indicates it is more likely to meet its obligations and can better withstand potential claims. Option is generally not a significant factor in risk assessment for reinsurance. Option C pertains more to the pricing structure, but financial stability is typically more important. Option D is important but not as crucial as understanding the ceding company's financial health. Relevant rule: NAIC Reinsurance Risk Evaluation Standards. Question 20. Treaty versus facultative reinsurance. Which of the following is a key difference between treaty reinsurance and facultative reinsurance? A. Treaty reinsurance is typically used for specific risks, while facultative reinsurance covers a broader spectrum of risks. B. Facultative reinsurance allows the ceding company to choose individual risks to reinsure, whereas treaty reinsurance automatically covers a block of risks. C. Treaty reinsurance is offered on a non-proportional basis, while facultative reinsurance is always proportional. D. Facultative reinsurance provides automatic coverage for all losses, while treaty reinsurance requires specific underwriting. Answer: B. Explanation. In facultative reinsurance, the ceding company selects individual risks to be covered by the reinsurer, while treaty reinsurance involves an automatic agreement that covers a group or block of risks without requiring individual approval for each risk. Option is incorrect, as treaty reinsurance generally covers a broader spectrum of risks automatically. Option C is incorrect, as both treaty and facultative reinsurance can be either proportional or non-proportional. Option D is incorrect because facultative reinsurance does not automatically cover all losses. It's selective. Relevant rule: NAIC reinsurance type standards. Question 21. Reinsurance accounting and financial reporting. Which of the following is the primary difference between the accounting treatment for proportional reinsurance and non-proportional reinsurance for the ceding company? A. Proportional reinsurance involves the ceding company retaining a portion of premiums and losses, while non-proportional reinsurance typically involves the ceding company retaining only premiums. B. Non-proportional reinsurance does not affect the ceding company's financial statements, while proportional reinsurance is directly reflected in both premiums and losses. C. Proportional reinsurance is recorded as net premium income for the company, while non-proportional reinsurance is recorded as an asset. D. Non-proportional reinsurance is recorded as an expense for the ceding company, while proportional reinsurance is treated as liability. Answer: B. Explanation. Non-proportional reinsurance typically does not affect the ceding company's financial statements in the same manner as proportional reinsurance. Proportional reinsurance, where the reinsurer shares a portion of premiums and losses, is reflected directly in the ceding company's premiums and losses, while non-proportional reinsurance typically results in the ceding company retaining more of the risk and not impacting its financials in this way. Option is partially correct but does not fully explain the accounting difference. Option C is incorrect, as proportional reinsurance is reflected in premiums and losses. Option D is inaccurate because both types of reinsurance may be recorded as assets or liabilities depending on the structure. Relevant rule: NAIC Reinsurance Accounting and Reporting Guidelines. Question 22. Risk transfer in reinsurance. Which of the following best defines the concept of risk transfer in the context of reinsurance? A. The ceding company transfers the premiums to the reinsurer in exchange for the ability to increase its policyholder base. B. The reinsurer assumes a percentage of the ceding company's risk, typically through the payment of premiums. C. The reinsurer assumes the ceding company's exposure to certain losses in return for premium payment. D. The ceding company retains all of the risk, and the reinsurer simply provides advisory services. Answer: C. Explanation. Risk transfer occurs when the reinsurer assumes the ceding company's exposure to certain types of losses in return for premium payment. This allows the ceding company to reduce its risk exposure and potentially stabilize its financial position. Option does not capture the true essence of risk transfer. Option B is simplified view and does not describe risk transfer in full. Option D is incorrect because the reinsurer provides coverage, not just advisory services. A relevant rule: NAIC Risk Transfer Guidelines for Reinsurance. Question 23. Solvency and credit risk in reinsurance. Which of the following is most likely to affect a reinsurer's ability to meet its obligations under a reinsurance agreement? A. A significant increase in the ceding company's retention levels. B. A downgrade in the reinsurer's credit rating by major credit rating agency. C. Change in the geographic distribution of the ceding company's portfolio. D. An increase in the reinsurer's administrative costs. Answer: B. Explanation. A downgrade in the reinsurer's credit rating is a significant concern, as it may indicate a higher likelihood of the reinsurer not being able to meet its obligations. This could make the ceding company hesitant to continue or expand its relationship with the reinsurer. Option C do not directly relate to the reinsurer's ability to meet obligations. Option D may impact the reinsurer's overall profitability but is less likely to affect its solvency. Relevant rule: NAIC Solvency and Credit Risk Guidelines. Question 24. Regulatory oversight of reinsurance. Under Idaho state law, which of the following is required for a reinsurer to accept business from a ceding company in the state? A. The reinsurer must be licensed in Idaho or listed on the NAIC's approved list of reinsurers. B. The reinsurer must demonstrate its ability to cover claims in excess of $1 million. C. The reinsurer must have minimum of 3 years of operations in the reinsurance market. D. The reinsurer must submit an annual report to the Idaho Department of Insurance detailing all claims and losses. Answer: A. Explanation. Idaho law requires that reinsurers either be licensed in the state or be listed on the NAIC's approved list of reinsurers to legally accept business from ceding companies. This ensures the reinsurer meets necessary financial and regulatory standards. Option B is not specific requirement in Idaho. Option C is not required for all reinsurers. Option D is not general regulatory requirement for reinsurers in Idaho. Relevant rule: Idaho Department of Insurance Reinsurer Licensing Requirements. Question 25. Reinsurers risk management. In which of the following scenarios would a reinsurer be most likely to utilize a retrocession agreement? A. To transfer risk associated with a large catastrophe to another reinsurer. B. To increase the overall premium income by expanding the geographic footprint. C. To limit the amount of risk exposure on individual policies underwritten by the ceding company. D. To reduce administrative costs associated with reinsurance claims. Answer A. Explanation. A retrocession agreement involves a reinsurer transferring risk to another reinsurer, often in the case of large catastrophes or substantial risk exposure. This allows the reinsurer to manage and diversify its risk portfolio. Option B refers to expanding risk, not managing it through retrocession. Option C is a characteristic of the original reinsurance arrangement, not retrocession. Option D is not typically a primary reason for retrocession. Relevant rule: NAIC retrocession guidelines. Question 26. Reinsurance pricing and negotiation. When negotiating a reinsurance treaty, the ceding company and reinsurer agree to a retention level. Which of the following factors most likely influences the retention level? A. The reinsurer's administrative costs. B. The ceding company's risk appetite and capital structure. C. The market share of the ceding company. D. The historical performance of the ceding company's claims. Answer B. Explanation. The retention level in a reinsurance treaty is influenced primarily by the ceding company's risk appetite and capital structure. The ceding company determines how much risk it is willing to retain, balancing its financial resources and the desire for risk mitigation. Option is not as impactful as the ceding company's risk appetite. Option C could affect the business dynamics but does not directly set retention levels. Option D impacts the underwriting process but does not determine the retention level directly. Relevant rule: NAIC Reinsurance Pricing Guidelines. Question 27. Reinsurance market and trends. Which of the following factors most likely contributes to an increase in reinsurance premiums? A. A decrease in global economic uncertainty. B. A significant reduction in claims frequency and severity. C. An increase in catastrophic events affecting the global market. D. A rise in reinsurers' capacity to underwrite more risks. Answer C. Explanation. Catastrophic events increase the overall risk in the reinsurance market, prompting reinsurers to raise premiums to cover potential losses. When the frequency or severity of such events increases, reinsurers adjust premiums to maintain profitability and solvency. Option: it would likely reduce premiums as less uncertainty would stabilize the market. Option B suggests reduced risk and thus lower premiums. Option D could increase competition and lead to stable premiums, not necessarily an increase. Relevant rule: NAIC Guidelines on Reinsurance Pricing Adjustments for Catastrophic Risks. Question 28. Ethics and Professional Standards. In the reinsurance industry, which of the following is an example of unethical conduct by a reinsurer? A. Offering a ceding company a commission discount based on volume of premiums ceded. B. Engaging in a retrocession agreement to manage risk exposure. C. Withholding material information that affects the risk assessment process during negotiations. D. Providing financial assistance to a ceding company to help it maintain regulatory compliance. Answer C. Explanation. Withholding material information during the negotiation process is unethical as it distorts the true risk profile and could result in unfair contractual terms. Transparency is a key ethical principle in reinsurance negotiations. Option A is generally accepted if the terms are disclosed properly. Option B is a normal risk management practice. Option D is permissible as long as it's within regulatory guidelines. Relevant rule: NAIC Code of Conduct for Reinsurance Professionals. Question 29. Claims handling in reinsurance. A ceding company faces a major catastrophe, and several claims exceed its retention level. Which of the following actions should most likely occur first under a typical reinsurance agreement? A. The ceding company should immediately adjust the claims reserves to reflect the amount of reinsurance recoverables. B. The reinsurer should confirm the validity of the claims before reimbursing the ceding company. C. The ceding company should notify the reinsurer about the claims in a timely manner and provide necessary documentation. D. The reinsurer should offer the ceding company an increased limit of coverage for the event. Answer. C. Explanation. Under most reinsurance agreements, the first action is for the ceding company to promptly notify the reinsurer about the claims, providing necessary documentation for review and potential recovery. Failure to notify timely may breach the reinsurance contract. Option is a later step once the claims are validated by the reinsurer. Option B is typically part of the claims review process, not the first action. Option D may happen in certain situations but is not the usual first step. Relevant rule: NAIC Claims Handling Guidelines for Reinsurance. Question 30. Reinsurance audits and reviews. During a reinsurance audit, an auditor identifies a discrepancy in the accounting of reinsurance recoverables. Which of the following is most likely to be the primary consequence of such a discrepancy? A. The reinsurer may issue a statement explaining the discrepancy but is not required to make corrections. B. The ceding company may face penalties for failing to accurately report its reinsurance recoverables. C. The auditor may recommend a reduction in the ceding company's retention levels to address the discrepancy. D. The discrepancy may trigger full reinsurance audit and possible adjustments to financial statements. Answer. D. Explanation. A discrepancy in the accounting of reinsurance recoverables would likely trigger a full reinsurance audit, as it could impact the accuracy of financial statements and the ceding company's ability to meet regulatory requirements. Adjustments may be needed to ensure compliance. Option is not correct because auditors must recommend corrections for discrepancies. Option B could be consequence, but full audit is typically triggered first. Option C is not likely to be the first action. Retention levels may be revisited after resolving the discrepancy. Relevant rule: NAIC Reinsurance Audit and Review Procedures.